It's just one more string that they're pushing on to buy time. But the jig is up.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and I'll be your host for this week's episode. And we'll be joined very shortly here by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. Get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media won't provide. So just before we head over to the UK, please help us spread the word about this channel by hitting that like button right now. Hit the share button, of course, and share it with everyone. And don't forget to subscribe if you haven't already done so. Now, you can really help the channel by doing that. It really does help us. So go ahead and click away. And if you click on that black bell right there, you'll be notified in real time as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire.
Hey, great to have you back, Shane. Looking forward to getting this episode on the road.
Hey, Andrew. We've had so many questions this week from subscribers who are looking to know what you're seeing in the very, very short term. But you know what? The majority are asking about what you're seeing further out, a little bit further out. Now, I know that you have an update on the BRICs currency situation here. So let's start right there, can we?
Yes, Shane. Let's step through the action surrounding this upcoming BRICs launch. Now, the race by BRICs members to repatriate their gold to participate, and Yellen's realization that they have underestimated the scale of adoption, resulting in a sudden panic by the US to try and stop the upcoming launch. Now, we're currently evidencing a race by African and Middle Eastern BRICs nations to repatriate gold reserves currently in the custody of the US. As you can see, South Africa, Nigeria, Cameroon, Ghana, and there's 4 other African nations already that are each expressing concerns that their planned adoption of the non-dollar denominated BRICS settlement currency may result in their non-jurisdictional gold holdings being withheld or indeed sanctioned or in some way weaponized against them if they don't toe the line in the future. Now, these official concerns escalated last week following Trump's comments that he would not allow countries to go off the dollar because what he stated was, when we lose that standard, that would be like losing a revolutionary war. And these are his words. And then he said, this would be a hit to our country. Well, okay, so now whoever is in power is going to actually fight this. And the current administration, has also expressed similar concerns. We've looked at that before. And last week, it kind of moved on to the front burner. Now, there's a sudden realization that the US has grossly underestimated both the scale and the timing of such a de-dollarization move. And this was undoubtedly the subject of both Yellen and Biden's scramble visit to China last week. Now, Russia is chairing this upcoming multipolar BRICS meeting on May the 14th to the 19th, and China's presence is going to be closely observed by the unipolar, hegemonic Western central banks. Now, they'll be trying to assess just how far down the blockchain rails Glazier's BRICS payment system has traveled following the stealthy beta testing that began 2 months ago. Now, along with our liquidity providers facing the wholesale markets, it's also our contention that the beta testing of this gold-backed currency into a tight for supply, already tight for supply, physical market, has at the margin largely been responsible for this unfactored central bank demand, which, when weighed against a backdrop of ETF outflows, has mystified analysts. Now, liquidity providers exposed to the wholesale markets assess the need to secure physical to back this currency was largely responsible for driving this recent 2-month over $400 rally into the 2400s. Now, this rally commenced directly following the Fed interventions we observed in February, which was tripped off when gold moved sub 2,000 spot gold. And that was on February the 13th. That was a bottom. And obviously, yes, we have revisited that, but there's reasons for that we'll discuss. And we'll look at this current derivative-driven move through these returning central bank orders, but they've largely been laid off against the momentum-driven CTAs. When we'll look at this short-term action in a minute, but there is little doubt that Blinken's carrot and stick sanction dangling visit to China last week was primarily focused on finding ways to disrupt the grossly underestimated hegemonic dollar-busting Sino-Russia alliance. Now, while Blinken was widely reported by the mainstream media as focused on trial ballooning sanction threats to disincentivize China from providing support to Russia's ongoing Ukraine military operation, but this was already underway, and there would have been a far easier, less public way for the US to have done this. Now, this scrambled together tandem US official visit, by no coincidence, it follows the successful beta testing and upcoming formal launch of Glasnev's gold-backed de-dollarizing oil, energy, commodity currency later this month, 1st of May today. Right around the time this will be where we release Robert Kiyosaki's interview, which is going to be in a week from when you hear this recording. Now, Western central banks have grossly underestimated the sheer scale of physical gold buying undertaken by the Sino-Russia alliance over the last 2 months. Now, even worse, the gold has been sucked out of the hands of the officially sanctioned CME LBMA cartel's paper gold suppression scheme, and it's been alchemized into physical outside their control. Now, while Western officials are aware of and do report on the on-record foreign central bank gold accumulations, they're also aware of the significantly larger unreported off-record monetary physical gold purchases, which are flowing from the west to the east. Now, the ring fence, when you think about it, the scale of this 97% leveraged paper gold exiting this cash-settled CME LBMA ring fence, being converted into 100% physically backed NSFR compliant physical gold outside the cartel's wheelhouse, has caught them extremely wrong-footed.
Hey, Andrew, as you outlined in our last episode, this forced compliance leads right back to what you've been talking about for a long time, Basel III, the NSFR regulations, where every central bank except the Fed and every gold exchange bar the Fed sanctioned, COMEX, had to become compliant. Do you see this coming to a head right now?
Yes, Shane, and thanks for the subscriber questions for that. Following the 50 years of Fed's management of the cash-settled COMEX Gold Futures Exchange, the Fed is the only remaining global central bank that has not complied with Basel III NSFR regulations, meaning COMEX gold diluted with unbacked paper gold settled inside the COMEX casino's ring fence is grossly underpriced versus the physically deliverable gold price being discovered globally in the 10 times larger NSFR compliant physically backed physical exchanges. Now, the ramp up in physically settled global central bank demand has evidenced a significantly higher real supply demand price to emerge outside the paper diluted CME LBMA ring fence. Now, the Fed's vulnerability lays within their paper gold versus dollar settlement structure. Now, in order for the Fed-run, non-compliant paper diluted COMEX exchange to remain credible, it has to facilitate the ability to EFP COMEX gold open interest into the FX global spot markets. And as we previously outlined, the EFP backdoor is just the paper markets. It's the paper markets' Achilles heel. And up until the BIS recategorized FX gold as a first-year asset class on the 1st of January 2023, historically by design, the official gold price suppression scheme enabled unallocated COMEX gold to exit this EFP backdoor. We've done tons of episodes about how that works. What happens then? This outflow landed into the hands. It used to land in the hands of the same actors unallocated over the counter book. So these unbacked gold positions could be endlessly shuffled between the sanctioned market-making cartel members who had a footprint in both the cash-settled, unbacked COMEX exchange, as well as the previously unbacked 10 times larger, unregulated, bilaterally settled, over-the-counter FX markets. Now, as an example, out of the historic 600 to 800 tons of gold cleared, shuffled daily on the books of a closed loop of a daisy chain of cartel members, real physical deliveries determined at the collusive gold fixes have only ever averaged a relatively tiny 3 to 5 tons a day versus the 600 to 800 tons of gold cleared and shuffled amongst the books. However, following the BIS recategorizing FX golds as a first-year asset class, every liquidity provider providing liquidity into the FX gold market has to be physically backed. Which has opened up the multi-trillion-dollar FX gold market to be marked to market alongside first-tier treasuries, enable them actually to be swapped for first-tier gold. And this explains the divergent inverse correlation disconnect between US dollar treasuries and gold. And it also explains why the mainstream media just fails to grasp why gold has been rising alongside the US Treasury yields. Now, the option for foreign central banks to be able to swap their US Treasuries, FX dollars essentially for gold, reopened the window that Nixon had slammed shut 50 plus years ago, once more enabling foreign central banks to be able to swap their rapidly debasing dollar-based investments for physical gold. And following the dollar being weaponized against Russia, Yellen and Blinken's visit to China foreshadows similar sanctions could be actioned against an increasingly multipolar leaning BRICs alliance. And ironically, sanction threats are exactly what's accelerating the current race by the Sino-Russian BRICs alliances into a sanction-proofing wealth protection race to swap excess dollars and US treasuries for physical gold. This is also evidenced by the current race to repatriate BRICS nations' gold reserves. That same opportunity to invest in physical gold or to repatriate worthless ETF holdings into direct physical ownership is open to us too, especially if you are invested in an ETF. Now, interestingly, Nebraska became the 12th state to end income tax on gold and silver. And importantly, all of these state sound money adopters really declare the CBDCs, the central bank digital currencies, are not lawful money. Now, Kinesis is a massive supporter of the sound money movement and have a close relationship with them. So please also show them your support, guys.
Hey, Andrew, now the Fed is left as the sole outlier seeking a lower gold price versus the dollar. They must be left reeling by the gold price breaking out into all-time highs. Now, how do the Bank of International Settlement compliant central banks view this breakout?
Excellent question. And the current 2-month over $400 gold rally has been fully embraced by by European, Asian, Middle Eastern, BRICs Plus, and a string of the pipeline BRICs adopters. These NSFR compliant central banks view this gold price appreciation as helpful. It raises the current backing of around, it's a fairly unified plus or minus 4% of gold reserves versus GDP backing up their respective foreign exchange currencies. Now, into the gold price rise, NSFR compliant central banks haven't had to tap into their respective gold revaluation accounts to bolster this percentage of gold versus GDP that ultimately benchmarks their respective currencies versus gold. So far, that is, but it's coming. And when Glasnev's gold-backed BRICs currency is formally launched and it is realized that the currency is far more liquid than was assumed, because it's ultimately backed by what liquidity providers assess as an aggregated 60,000 tons of gold. And of course, we've in the past, we've done episodes on how China views this. In the event of war, the PBOC has telegraphed that they can equitably access the over 20,000 tons of citizens' gold and provide on a return basis. And that's all, they've outlined that fully. So when you think about it, this is a huge amount of gold. Western-facing central banks will be forced to raise the percentage of gold held versus GDP to mitigate this upsurge of inflationary pressures of commodities paid for in dollars, forcing a global gold price revaluation event. As the dollar depreciates against these goods benchmarked by the alternate BRICs gold-backed settlement currency, the scale of the completely unfactored inflationary pressures poses a hypersonic threat to the US dollar hegemony, which will catch Western central banks off guard. And this is why we're evidencing a desperate attempt by the US frontline leaders to try and buy time to unwind their 8,133 tons of rehypothecated, deeply underwater central bank gold reserves. They will do everything in their power to try and undermine the key Sino-Russia currency anchor. The latest multi-billion-dollar Ukraine funding to try and undermine Russia is just one more string that they're pushing on to buy time. But the jig is up. As we've looked at closely over the last 2 months, the rally in gold has defied the experts attempting to understand the real reasons gold and related silver have rallied without and despite the lack of paper-centric CDA participation. Now, an official effort to cap the gold price, and all official efforts to cap the gold price for that matter, are limited to how many momentum-driven CTAs that they can lure into going long or short, because they're never going to make delivery or take delivery. And the drivers that have forced the dislocation from a full spectrum of programmed algorithm bots, which have historically traded inversely to a stronger dollar index and rising treasury yields. So this has served to wrong foot the over-leveraged paper-centric momentum-chasing CTAs. This is where we are now. And being siloed into trading the cash-settled, non-delivery COMEX markets, these CTAs have zero visibility into the underlying strength of the 10 times larger NSFR-compliant, physically backed gold and silver markets. Now, paper gold's so-called specialists completely miss that the first-tier gold is increasingly being physically settled outside the cartel-run legacy CME, LBMA ring fence. It's not actually rocket science. It's simple. It's that simple. Since Basel III NSFR conditions revalued FX gold as a first-tier asset class, FX gold had to be physically backed. That's a big change. And they opened up a conduit that enabled treasuries to be also swapped for gold. And explaining this divergent at the margin inverse correlation disconnect between US dollars and gold.
So, Andrew, I think since the first episode we did, it's the physical market right now that is forcing the paper market to disconnect. Is that correct?
Yes, Shane. So in summary, what has accelerated the current 2-month paper to physical divergence is the race by central banks to diversify into physical gold. Now, the gold rally has almost exclusively been driven by Russia and China aggressively buying physical gold to provide sufficient liquidity to back Glasniev's alternate beta-attested gold-backed commodity currency. So given that this expanding number of current BRICs members generate and or consume the lion's share of the multi-trillion-dollar oil and energy complex, the successful adoption of this alternate SWIFT settlement currency will drive this unfactored, highly inflationary de-dollarization process. Now, commodities priced in gold will be stable, but as the multi-trillion-dollar oil trade increasingly migrates into the BRICs gold-backed clearing mechanism, it's going to require additional central bank gold to be purchased, which will ultimately force global gold price revaluation on the Western BIS compliant central banks, who on average have around, as I say, 4% gold versus GDP backing their respective fiat currencies. They're going to need to up that. And this leaves the Fed, the only central bank still betting against gold. Empirical evidence indicates that a significant percentage of the 8,133 tons of Treasury gold the Fed manages on behalf of US citizens are rehypothecated. This indicated that 4 to 5% of gold they purport to have to back the percentage of foreign debt outstanding is actually in reality likely massively in deficit, a negative number. In other words, the Fed's only solution other than to default is to revalue Treasury gold to market. One thing for sure, oil priced in dollar terms will diverge significantly higher, and estimating the layered scale of BRICs adoption, by the end of the year, liquidity providers estimate $200 gold oil is entirely possible. And if gold is not revalued to market by Western central banks, the inflationary fallout stemming from oil priced in unbacked dollars would be sufficient to trigger a too big to fail derivative market implosion. This could not be averted. And you can ask anyone, if gold was trading at $200 to $300, what kind of a derivative implosion would happen? Now, a very likely South China Sea or Taiwan escalation looks increasingly possible, even if it's by mistake. And if triggered, likely gets close to Russia's estimate of $300 per barrel. Yet oil and commodities priced in gold would be relatively stable. That's what's spooking these officials. Large covert monetary gold purchases by the PBOC reflect a ramped up strategic de-dollarization process. And if you go back a few episodes where we focused on how China had been able to covertly accrue some of this 40,000 tons of gold by exchanging some of their hidden over $3 of FX of the FX shadow banking reserves that the US Trade and Treasury representative, which was Setster, he drew attention to back in 2022. That's only a couple of years ago. And as we outlined previously, it is sure that the Fed is as best as possible trying to manage the exit of their 8,133 tons of largely rehypothecated Treasury positions, spurred by what our liquidity providers report is an overwhelming queue of foreign central bank repatriation quests. Some of them are not even on the record. Ironically, all of this echoes Setser's concerns about China posing risks to the global economy. In fact, it's echoing Setser's word. It is, in fact, the Fed that is now presenting a new risk to the global economy.
And finally, Andrew, let's answer the question that came right up at the top of the show, which a lot of people asked, is that what are you seeing now in the markets short term?
Very short term, looking at the bigger picture, the action has been constructive. What we have seen is we've seen the bulk of the exit of the CTA long froth. You know, these are the guys that buy a long position or never take delivery and are easily rinseable. And of course, it's so simple. You go to a moving average like the 10-day moving average. That's their trigger point. They automate the algos are triggered to it so that you see a bunch of people exiting. Then we also see a round number being targeted. The dip sub 2,300. But what happened there, while there is this cover of paper market selling, naked short selling at this kind of point, we see a large layer of these rinseable CTA shorts accruing. Dips are going to continue to be physically sought. And we're recording this episode on Wednesday ahead of FOMC. And of course, Friday's non-farm payrolls, which you'll have the data on when this is released. So with most sitting on their hands, we expect the obligatory Fed-driven, algo-driven volatility to continue for now. However, given the array of stagflationary news outputs, we see a hawkish Fed spinning inflationary rate cut delays as a solid reason to step up gold and silver buying. Stagflation is a perfect environment for gold and silver. And following 2 weeks of healthy consolidation that has seen, if you're a 10-minute chart trader, you're pulling your hair out. No. Look at the bigger picture here. We just had a massive rally. It's healthy consolidation, i.e. ditch these useful fools that have joined on board. And it's seen the rinsing of naked long, non-sticky CTAs. And we'll look at the underlying bullish for gold drivers that has kept a bid under gold into the concerted effort by officials to try and really chart paint a gold correction into what were technically overbought conditions. Now, these efforts followed gold coming close to triggering another layer of central bank buy stops at 24.50. Now, the high being 24.48.80, actually. This is when the orchestrated mainstream medium spin began. I always watch US mouthpiece Bloomberg Intelligence. Oh, I watch Bloomberg all the time. It's not a problem. I seek them for good data. But when we see the Bloomberg Intelligence guys coming, whether it's Ukraine, whether it's whatever it is, you have to know it's an official spin. And what they were doing was attempting to parachute in and try and gaslight a gold market correction narrative, which came in telling investors to sell gold. And what made this so obvious is this call was based on really just a tiny one-day $41.50 pullback, which had just followed a 2-month long $450 month gold rally, printing an all-time record high. So look, given the technically overbought conditions, we expected the naked long CTAs to take the bait, but we also know that the led by the nose CTAs dip below the central bank physical bids at 2,300 will be forcing the commercials to take the long side of the herd of naked short momentum sellers. Now, the dip sub very large central bank physical bids below 2,300 will ultimately backfire. Now, here's an example that we captured last Friday when the April futures contract was called for delivery. Now, bearing in mind that you need to explain this. So the first notice day for April delivery of the COMEX contract was pegged really at the end of March. And gold was trading at 21.75. So the shorts holding these delivery obligations had a maximum of 30 days to make delivery under that warrant. Now, as a note, it would be far cheaper for a genuine seller to really discharge the friction of holding this insured, stored bullion as quickly as possible to completely discharge this obligation. But having not done so, as the last day to make delivery of the April contract approached last Friday, it became quite clear that these COMEX sellers who'd been dragging their feet in the hope that they could rig the gold price lower had got it wrong. Now, historically, over the course of a 30-day period, this old cartel trick to delay delivery found ways along the way to disincentivize their longs waiting to take delivery to fold their hand by discounting the price. They failed. And as we have captured here, with the price having risen by a massive $175 per ounce to spot 23.50, which this is the spot chart, you can see that price at 23.50, with no other bullion to deliver, the insiders had two options: convert the short sold futures contracts into physical, or to buy back the short bet at a loss. Having exposed themselves to being naked short, and with spot gold rising above 23.50, as captured here, you'll see that a massive over $30 premium over spot was being demanded just to buy back these bets. Okay, yes, they managed to trick in fresh sellers yesterday, which was the very last day of delivery. But it hasn't gone unnoticed. This whole process hasn't gone unnoticed. And really, they've been caught with their hand in the till. And what it illustrates is that the attempts to buy these lot back into a rigged discount had actually failed. And while the Fed agent banks were able to be bailed out for cash, it's the 97% of mark-to-market leverage unwind that was the problem for them. The upside breach of this spot 23.50 round number had spooked shorts, driving the April GC premium to this over $30 premium to exit these obligations, cash settle these obligations. And this evidenced tightness in the physical market for immediate delivery. And while officials managed to chart paint a lower weekly close in both gold futures and silver futures, current prices are too close to central bank support to really risk adding too much more to running personal naked short supply in excess of how many CTAs can be sucked in to sell, basically. Now, given the large T+2 spot delivery overhang following this options game dips into the spot round 23 number, and the proximity of fresh reported central bank bids reaggregated at spot 2300, and that's equivalent to futures 2310 in round numbers, has required a very large supply of naked short CTA sellers for commercials to offset the ETF delivery exposure, the EFP delivery exposure, excuse me. Now, we see dips to be jumped on by central banks. Now, as the COMEX once more trips out the led by the nose CTA naked longs, both gold and silver futures have consolidated healthily, ditching this CTA froth and sucking in fresh naked short supply, all this time working off the technically overbought conditions, which, following FOMC today, by Friday's non-farm payrolls report, no matter what, of course it's going to be a politically salt beat. So by the time the dust has settled, gold and silver will have reverted to actionably technically oversold condition. That will not be helpful for the insiders. Shane, silver is close to printing $1.50 below what even the insiders' option sweet spot is at $28. The dip below has tightened up wholesale supply. And given the expanding disconnect between the strong Chinese, Indian physical market demand and the influx of naked paper market supply, liquidity providers expect silver to be first out of the gate to rebound. I know you'll like that, Shane. Well, now we have outlined the short term, and we've outlined the bigger picture footprints. But really, there's only one question left to ask. And it is a question that Robert Kiyosaki has ended most of his podcasts with. Guys, how much physical gold and silver do we collectively own?
All right. Thank you, Andrew Maguire, for talking gold. And remember to our Live from the Vault community. Buy physical, make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same, and don't be fooled. So there you have it. That's all we have for you this week on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button right now if you haven't already done so, and share this information, subscribe, and click on that bell if you'd like to be notified as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.